Hello everyone, my name is Shoiki Promarma, registration number 2023221009. Today I will present a quantitative analysis of market risks and volatility focusing on chapters 22 and 23 of our financial economics course. Our session today is based on practice exercises from Basu and Hall's Options, Futures and Other Derivatives book. We have three primary goals: calculating value at a risk and expected shortfall for multi-asset portfolios, modeling nonlinear risks and forecasting volatility using EWMA and GARCH models. We begin with a portfolio consisting of 3 lakh in gold and 5 lakh in silver. The daily volatilities are 1.8% and 1.2% respectively, with a correlation coefficient of 0.6. By accounting for this correlation, we find the daily portfolio volatility is 1.275%. Because risk increases by the square root of time, we scale this to find a 10-day volatility of 4.03%. Ultimately, at a 97.5% confidence level, the 10-day value at a risk is approximately $63,200. Expected shortfall and diversification. Moving beyond VAR, we calculate the expected shortfalls, which captures tail risks at approximately $75,300. It is important to note that the expected shortfall is significantly higher than the VAR, showing that if a worst-case scenario occurs, the average loss is much deeper. However, we see a clear diversification benefit of $7,450, representing a 10.5% risk reduction compared to a non-diversified portfolio. Even though these assets are positively correlated, combining them still provides a free lunch in terms of risk management. Delta linear risk approximation. Now let's look at an option portfolio on a $10 stock with a delta of 12. In a delta linear model, we assume the option price moves in a straight line relative to the stock. It gives us at 1 day 95% volatility at a risk at a 3.95, but options are curved, not linear. When we refine this using a negative gamma of minus 2.6, we apply a quadratic model. This minus 130 term shows that whether the market goes up or down, the negative gamma will lower the portfolio value, making the actual value of risk higher than the linear model suggested. In the chapter 23, from the practice exercises 23.17, volatility updating. Finally, we look at updating volatility after a gold price shift from 300 to 596, which is a long return of roughly minus 0.006688. We use two models, EWMA, which reacts faster to recent news or price shocks, and GARCH 11, which includes a mean reversion component. Under EWMA, silver volatility becomes 1.45% and correlation decreased to 0.79. Under GARCH, the updated volatility is slightly higher at 1.46%, with correlation also remaining at 0.79. As a final point of interpretation, it is not realistic to assume a common long-term average variances for gold and silver, as they have different market structures and liquidity. From the main sentences, there is the volatility clustering, model sensitivity, and the risk management. These exercises demonstrated that effective risk management requires looking beyond a simple linear models to account for tail risks, curvature, and evolving market correlations. Thank- from the exercise 23.18, volatility updating using the two models in exercise 23.17. EWMA model from the updating version of the correlation. Here we find that the new correlation is obtained by dividing the updated covariance by the product of the updated volatilities using the updated gold volatility from question 23.17. The result is 0.01271 and the silver volatility must computed. Thus, under the EWMA model, using the formula, the volatility of silver becomes 1.45% and the correlation decreases slightly to 0.79. And the GARCH 11 model for correlation Hall's framework typically continues to use the same covariance updating approach as in EWMA. Therefore, the covariance remains 0.000146664. Thus, under the GARCH model, the volatility of silver is 1.47% and the correlation is again approximately 0.79. And in the last slide, we concentrate on the interpretation and the final results. The parameter W represents the long-term average variance level in the GARCH model. Since gold and silver are different assets with different market structures, liquidity conditions, and inherent volatility characteristics, their long-run variances are not the same. Therefore, it is not realistic to assume a common W for both assets. And in the finding results under the EWMA model, the updated volatility of silver is 1.45% and the correlation becomes 0.79. Under the GARCH 11 model, the updated volatility is 1.47. 1.46% and the correlation remains approximately 0.79. Thank you everyone for your attention. That's it from my part.